In this video, we discuss one of the very best earning models to invest in for the long-term financial freedom. It's really simple. Passive investing in a few great earning models, holding them for the long term and just enjoying life. This is really how it works, and I'll show it myself in my own portfolio. In this video, we're going to talk about three things. First of all, what is that best earning model? Secondly, how does it work? Very simply explained in essence. And thirdly, a concrete explained example in which I recently took a pretty large position in the past period, including my transactions as shares of this company. First, a little explanation about how it works. But before I do that, first, some evidence of the hundreds of hours I've invested in learning this earning model and understanding this market. Let's start with a little bit of context. My name is Jorik Vermeulen. I am entrepreneur and investor. For more than 10 years, I started at 23, and by 30, I became financially free. And I'm on my way to financial independence. I share the journey on Happy Investors. What is the difference? Financial freedom means that you can basically work a little less if you would want that. Financial independent means that you can simply live off the returns or dividends depending on your choice. Now, I know by now I will never stop working, but that's another story. I grew up with an entrepreneurial father, and that's obviously in your nature. It's a certain way of thinking. Let me also have an innate talent and way of thinking for that. It also has its downsides, by the way, but I am really an entrepreneur. I see a lot of opportunities. And I also invest a lot in stocks, but not just in stocks. I also have my own business, Happy Investors. And I also have shares in non-stock market results, software company, and more will be coming soon because I am on my way myself also towards creating one of these best earning models. That earning model is called serial acquirer. In other words, a holding company. In other words, another name. Simply put, you invest in multiple companies that you acquire, and then you help those companies grow operationally and so that you generate more and more cash flow. Because as you keep acquiring more companies, the cash flow will increase in the long term, and I will explain that in more detail shortly. In recent years, I've obviously read a lot about that. It's definitely important to be an entrepreneur to really understand what this earning model entails. The earning model is based on private equity. Basically, private equity is about buying companies with debt, optimizing them, which sometimes means cutting costs, and then selling them after 5 or 7 years. But with private equity, it's really all about achieving the highest possible return. It is also the case that up to and including the data up to now, that private equity achieves the highest average return, higher than, for example, stocks. Yes, that's a good question. The essence of private equity is great, but there are, of course, some downsides to it. So an example is, and that's been described in biographies like Barbarians at the Gate, that there actually leverage buyouts were done, and those companies were then trimmed down, destroyed. A lot of people were laid off, and that sort of thing. By the way, it's not really a great book, and I also don't really think the biography of King of Capital is worth reading. In a moment, I'll share some more books that are great to read about this earning model. Only private equity essentially has a number of very significant advantages, including the fact that you indeed use a bit of debt, but you also have good debt. You can use debt in a good way. Then you also give a lot back to the management. So you give them shares. At least it buys itself in, often it's 20%. So the management is motivated by insider ownership. And this is super important. At Happy Investors, we do it too. We now have a team of 4. Another one is coming, but we are all co-owners. So I founded the company and the rest bought themselves in with shares. And together we are expanding it further. There's a fundamental difference between being a shareholder and feeling like a co-owner or not. Just take a look at yourself, how you act at work. I can tell you that, especially if you are a co-owner, you will approach things very differently. So the business model is super interesting because you actually set up the management of the acquisition you make to also let them grow. And the harder they work, the more they grow too, both financially, but of course also mental personal development. There are a number of other things like long-term incentives and things like that for private equity. I'll explain that properly in another video. A few books that are super interesting include, of course, learning the basics and the theory, like Mastering Private Equity. You also have a very accessible book for those who want to start as beginners. An example of that is Buy Then Build. I've also read some other books, but I didn't find them worth the effort. What I really find worthwhile is Masters of Private Equity and also a bit about venture capital. This is a really great book. Make it yourself frequently. Various summaries. But nowadays, I just act on what is good. And every Once in a while, I read the book again to remind myself just how good it really is. Of course, there are also various other books available for download, like Serial Acquire, but I want to talk about also, for example, the letters from Constellation, software company. As you can see, there are a lot of them. It starts from 2007, and yes, there are a whole lot of them. I've actually printed out and kept the ones I've analyzed with important lessons. Those letters are compiled by Leonard. That's one of the founders who is known for applying serial acquirers. In other words, the acquisition of niche companies holding a lot for the long term, and private equity is acquiring, optimizing, selling, holding company. In other words, serial acquirers buy up, hold for the long term, grow later, and basically never sell again. So then you basically have a payback period. Once you recoup your investments, you actually have infinite growth, as long as you keep the company strong. In terms of profitability, there are all sorts of principles that they apply. Let's take a look at that. The principle of a holding company or serial acquirer is quite simple. A lot of financial discipline is needed. Stones, we have happy investors, and we're going to start a holding company. It's something I'm definitely going to do in the coming years, and I will share everything in Barais via YouTube and, of course, the company Happy Investors. In the first year, we use cash, supplemented if necessary with debt, to take over our first acquisitions. According to financial discipline, these should be all sorts of niche companies with reliable cash flow and preferably from trustworthy management. Of course, these long-term incentives will help us optimize the company to generate more cash flow. At the end of the day, we have free cash flow, left over this year. Free cash flow goes back to the holding. The holding company thus creates more cash flow. With more cash, supplemented if necessary with debt, we're going to make multiple acquisitions. This is year 2, and in year 2, by successfully making acquisitions, we generate even more cash. Even more cash goes to happy investors, and the flywheel has started turning. We can possibly pay off some debt, of course, and reinvest the cash we have left into new or good acquisitions. That can be 3 companies, it can be 1, and it can also be many more, depending on the strategy. Ultimately, because we generate so much cash flow, the process will accelerate itself and will keep going indefinitely, which means that over time we generate more and more cash, and you can keep repeating this process simply thanks to financial stability and financial discipline. When selecting serial acquirers to invest in, meaning those that are already publicly listed, I personally look at a number of factors that I find very important. First of all, the ROE, the return on equity, and the ROI, return on invested capital, must consistently be above 15%. Of course, it's not always possible to have it consistent, but the average line needs to be high. There must be financial discipline, where the debt to EBITDA absolutely stays below 3, and preferably even a little lower. Management is a very important criterion. They must be credible, reliable, keep their word, and of course be knowledgeable. The market needs to be interesting enough, preferably fragmented. And finally, it's crucial. In combination with the management, there's the strategy. Preferably invest in companies that have very specific industry expertise, where they acquire niche. Companies with a niche position, preferably leadership or number 2 in the market. Those who can also apply operational excellence because they are in a specific industry, and they also create niche leaders. They can also create additional operational value thanks to the insights they share. Think, for example, of best practices. And finally, a very important criterion, they need to consistently invest in asset-light revenue models. As you know, asset-light revenue models are the most interesting for the long-term growth. In the third and final part of this video, we're going to talk about a specific example of a serial acquirer. I think it's very interesting, and it could make me financially free, and maybe you too. But keep in mind, I can of course sit next to you, so this is absolutely not personal advice. I'm just going to show you what I do. Also, subscribe to our channel if you want to receive something every month. I want to receive this when we review the portfolio, or when I buy new stocks. I will also make new videos about that, of course, just for inspiration. The stock that I bought is Neon. I've had that one for a while. However, recently Neon has dropped a lot, in a short time, and then also to climb back up. So that was a unique buy the dip opportunity for me. but it could very well be that the decline continues. Neon is a very small company, a market value of about 250. This was once 350 million, because you can see that here was the peak in 2024, but they come from a deep valley, and that's a very low price compared to the current price. So the stock has already gone up 6 times or something like that. And recently, it has actually dropped quite a bit. And the latest figures were really bad. And that's why the stock has dropped further. Now, it seems like it's not that bad. However, let's take a look based on candles. Then you see that the lowest price level of the past week was about 144, around that, and then became pushed back to a higher price level. Now, I've had Technion for a while, and recently I bought a few more shares. No, this is a relatively small company, but 250 million in market value. And I recently did this on February 17. When there was a dip, I was able to buy at an SEC level of 150. A buy, by the way, SEC is the Swedish currency. And you can definitely see a significant buying moment around a little more than 5,000 euros. And that was just over 35% of the total position. I've actually had Technion for quite a while, since 2024. And I bought the first shares around mid-2024. Actually bought a bit too much in my enthusiasm. It was a bit of a risk too, because it was in a downward trend. As you can see, a downward trend is never really good. So I don't really know if the stock is going to stabilize at the current price level of around 160. We'll see. In terms of appreciation, it is somewhat in line with 2021, 2022. So it might not be the absolute best moment to buy more, but the key is to consistently add to your position for the long term. And for that, you need conviction. Conviction is really important if you want a company to make you financially free in the long run, because you really have to keep holding on. I'm going to highlight a few things about Technion, why this is such an interesting little company, if you ask me. Maybe before we get to the latest figures. As a result, there has actually been a 15% drop in the stock price. I'll show you why I just find it a really interesting company. But first, let's start with management. Technion was founded a while ago by Johan Stennen, and that is still on the helm. He's super honest. And what you want is to invest in honest management. In this latest update, he also indicates again that the acquisitions he made a few years ago aren't turning out so well. What also now results in relatively poor quarterly figures. But keep in mind, quarterly figures are very short term, and this is about building for the long term a vehicle that generates higher return on equity, because consistently higher return on equity and return on invested capital simply ensures that the EPS grows along the same lines and the stock price follows the EPS. And that EPS can, of course, vary if management decides to buy back or sell shares, for example. So that's another factor with EPS. But in the long term, the stock price will follow the EPS trend, where I will explain a bit more about shortly. Well, what I find really interesting is that Johan has quite a high level of insider ownership, but I also find it very interesting that Daniel Zeng has participated. I think this is a very reliable little guy. But yeah, he's a bit older than I am. So we have to say, sir. But a very smart guy. And they also have a number of CEO coaches on staff. The last one is Patrick Olsen. He joined as one of the acquisitions, also from Technion. Sent also the accounting expert Annalie has joined, and they have a very young CFO. Actually, if you want to think of a downside about the management, then it's actually that in recent years, they have had several CFOs. Yeah, for whatever reason, they all left relatively quickly as well. That's often a red flag. But in this case, because the management is as reliable as Johan Steinen and Daniel, I do have confidence in it that it's just all good. But I don't know the exact reason why the CFO left. Now, there are, of course, more downsides. So I have a bias because I just believe in this company. But make sure to be very critical yourself. You can see the reliability in a number of things. And you can already see that in the investor relations updates they provide every quarter. By the way, not yet. A long time ago, that was in Swedish, and only recently have they been doing it in English. So I would have had to translate all the Swedish reports into my language. But yeah, well, the technology of today. So we also create AI ourselves to set up our videos in, for example, English, and other languages. Yeah, it can all be done these days. Well, they honestly indicate that that's their performance from the last quarter. So, super funny. You actually don't get anything out of it. Because, roughly speaking, I'm just in the red with my shares, but I can appreciate that they are so honest. And again, I believe in the long term potential of this company. There are quite a few numbers here. You can easily read all of this yourself. What it's about is the current free cash flow, and pay attention. They report the free cash flow first and not the EBITDA, which is a positive sign because that free cash flow has almost been halved compared to the last quarter. That's obviously really bad. The EPS is also down 62% compared to the last quarter. And on an annual basis, that's down 26%. So those are obviously really bad numbers, but one quarter is, in my opinion, yeah, not to be misunderstood. Moreover, and I'll show that in a moment, what Daniel also points out in this latest quarterly update, because every time they provide a video update, Technion is still so small that the organic growth, also the impact of organic operational performance. So the companies that are in the holding, if they perform poorly, it has an immediate effect, a big effect on Technion. But the biggest growth comes from new acquisitions. Just because Technion is still so small, they can simply make a lot of acquisitions, which means the Technion team is only getting bigger. So they have now made a number of investments, and there aren't even that many. For example, this company here, M1, that's an architecture firm in Sweden. It's performing really poorly at the moment. Bad. Yeah, and there are a few other acquisitions like this that are simply bringing the results down in the short term. But this is just the beginning of a series of strategic niche acquisitions that Technion is going to make. I truly believe in that. And there are a lot of green checks you can make for this company. Recently, they are also making more acquisitions in the UK. But before we do that, let's get an update from Johan, the founder and also the CEO. I always appreciate his honesty, and read it all for yourself. But because their grade is an F, they are out for revenge. I think it's super important to read that over the last 3 years, they have actually made acquisitions on the relatively low side, about 3 to 4 acquisitions per year. For the coming years, they have been able to secure enough credit from the bank, and they are expected to be making more than 5 acquisitions per year. And very recently, that's today, still. But just after making this video, we see actually they have already made a new acquisition. So it's super important that you can trust the management in their word. That's really important. And I just believe in what they indicate is true. Why is it so important? Because these acquisitions can still have a big impact because the technology is so small. So I think that's a very good signal for the long term. Another point is the performance. We've talked about it. And once again, you can see all of this for yourself on the investor relations. One thing to understand in this strategy is that they initially focused a lot on acquisitions in Sweden. Somehow there are a lot of serial acquirers coming from Scandinavia, and they are all, of course, trying to expand geographically. Well, for Technion, that's in a nearby country, namely England, and the acquisitions they have made have a higher EBIT margin than the acquisitions from Sweden. And Johan indicates that he expects the English heel to be as big as the number of acquisitions from Sweden in the coming years. And that's basically the long-term strategy in a nutshell, according to the CEO. Another reason why I believe in Technion is that they maintain strong financial discipline. There is a clever, I think they have a sense of humor, but that's just my personal opinion. They also indicate that they are actually continuously busy meeting new companies, 100 to 150 per year. And as he points out, legend has it that it's even easier to win the jackpot than to be acquired by Technion. So what he means by that is that they have a lot of financial discipline. You can also see that in the net debt to EBITDA. Often a threshold of less than 3 is used here. Why? Because then you can actually pay off your debts relatively quickly, and you don't want to have a high debt ratio. But you can see that their target is actually much stricter. And this is also financial target number 1. And they really believe in the philosophy of Warren Buffett. They're trying to imitate that. And they are also very careful about having too much stuff. Because as you know, when you have too much stuff and the economy goes bad, you can run into trouble. I think that's also a bonus when investing in Sierra Aquarius, that the volatility will be a bit higher from time to time, especially because they use debt. So when things get tough, the debt can quickly pile up compared to the free cash flow that they generate. And that's why people quickly panic. So that's a little bonus material that I personally see. But it does mean that the risk level is a bit higher. Of course, whenever debt is involved, the risk level is naturally a bit higher. But they are very disciplined. Financial target 1 is about stability. Financial target 2 is about the EBITDA margin. And financial target 3 is about shareholder value, which is very important for you if you want to achieve financial freedom. Their goal is to double the EPS every 5 years. Well, a handy little trick is to divide something by 72 and you get a sort of annual return. If you want to double the EPS every 5 years and the assumption is that the stock price follows the EPS, that means you divide 72 by 5, which gives you a return of about 14% per year. And that also aligns a bit with the return on equity they are generating. They present a graph with the current stock price compared to the earnings per share, and I really like that. The black line here is the earnings per share development, and we see the stock price here that occasionally goes above the EPS line. Actually, it was below the EPS line for quite a while. So 2022 was a great time to buy. And at the center, it was a bit above again, and now it's just a little bit below. But you can also see that the EPS is declining. Well, what's crucial is that this EPS decline here in the short term is a safe phenomenon, and that it will rise again in the long term. I have confidence in it. They indicate what their last 10 acquisitions are, and most of them come from the UK. Their strategy in a nutshell is to invest in preferably asset-light technical companies. Their industry expertise is technology. Johan also has a technical background. Daniel is a bit less, but I think he is strategically a bit stronger. These asset-light revenue models are all in technology. Of course, you also want to grow that with best practices in operational value. I think management has taken a very important step here because they are super down to earth, they are honest, they are reliable, and they think long term. So I think in conversations with potential companies that want to sell, you always see the reactions of those people about why they sold to Technion, and it's always such a personal match. Also because they have the best interests of the companies they invest in. And in terms of target range, it's now here in the volume. This is the revenue from the latest acquisitions, and that's 28 million SEC. And 28 million SEC converted to euros or dollars is roughly $2 million, a little more per year. So the target range is between companies, as you can see here. Yes, ideally between 1 to 4 million in revenue per year. And they have clear, strong financial rules, such as that they must consistently generate profit, of course, and they really focus on profitability, not just EBITDA, but really looking at cash flow and profit. So in a nutshell, there are a few more management members. Take a look at all of that yourself, and of course, pay close attention to the details, the book value that is also mentioned, those kinds of things. Well, let's take a look at what Daniel has to say in response for the upcoming period, which I think is very important. Because Technion is young and small, the acquisition will naturally be our biggest growth engine for the coming years. In recent years, we haven't requested as many companies as we wanted. That will change this year. So you can listen to the rest yourself. It lasts 50 minutes and includes a lot of Q&A, so it's definitely worth taking another look at all these updates. So you can listen to the rest yourself. It lasts 50 minutes with a lot of Q&A, so definitely that keyboard to take another look at all these updates. Vermeulen, that naturally gives you more confidence in what they say, whether it's credible. The boards are also very interesting, not so much the chair of the board, but for example, this person here has a very high ownership in the company Technion. So this is a major shareholder. Johan is himself on the board, a few others, but what I really like is to see that Christopher Mayer has been a board member since the end of 2024. I had already bought my first shares in Technion actually before I knew that this person was joining the board. Why do I find that interesting? Christopher Mayer is, of course, known for the book 100 Beggars. Very interesting. So he invests in potential 100 beggars, in other words, stocks that can multiply by 100. And he has a relatively larger position in Argnion, so that's super interesting. I'm happy to see that. And I'm also very curious about what the effect of his expertise will be in the long term. As I mentioned, Technion will be making several acquisitions per year for the coming years, especially based on the UK. And today they posted another update about an acquisition. So this is another signal from management indicating, listen, we are going to make more acquisitions. That they immediately show that they've made an acquisition. Super interesting. I find it very reliable myself. But investing is of course a rational process. So you always have to look at the valuation. Valuation matters. And the current market cap, and by the way, it says in trillions here, but that's because it's about SEC. So calculated 2.7 billion SEC to dollars is around $250 million. Just a quick calculation. Of course, you can see that the market value has decreased, so the companies have become smaller. That has, of course, also to do with the profits, which are actually super bad because of Q4. Well, not super bad, but definitely much worse than before. But other things have dropped, like, for example, the price to sales ratio has decreased, and 1.7 isn't super expensive if you ask me. Price to book is still a bit on the higher side, but also a price to book of 3. Yeah. You tell me. And the enterprise value to EBITDA has now dropped to about 13.5. A few figures are good to know, like the return on equity around 15%. After the last quarterly figures, it's around something like 11% or a bit more. But in the long term, they've indicated that they can double the EPS every 5 years, and that return on equity will be above 15%. And I am convinced that the relatively young management will gain enough experience to grow, especially with board members like Christopher Mayer. So it's not just about investing in a company. This is investing in a growth process, a story. You really have to stand behind management to dare to buy more when the stock drops a lot. So I did that myself too. And I'm not giving this as advice because be careful, it's high risk. It could very well flop, but it's my money, and I'm convinced enough that I want to invest a lot in this because I think it's worth one of the big positions, as it can lead us to financial freedom in the long run. In the very short term, this trend is negative, that's clear. The MACD is starting to cross and is becoming a bit more positive, but of course, based on those latest figures, there's been a significant drop to a price level of 148, which is actually somewhat comparable to 2021 and a bit of the peak of 2022. I'm unsure if it will drop further based on fundamental levels. But you never know, in a downward decline, a downward trend, it can always get worse. Moreover, there might be some macroeconomic developments that could also throw a wrench in the works. For example, like Trump, who says, man, Europe, stand on your own 2 feet. Germany isn't doing too well with that. The economic growth in Europe isn't exactly great either, but I think Technion can simply address this through strong financial discipline and consistent management. They believe in Technion's management and the story and the well-being of the company for long-term growth, which is why they can achieve more attractive valuations to realize higher returns on their investments. That's what I think, and I'm really curious to see how Technion will grow in the long term. In a nutshell, there might be a lot of information. Do you have any questions about this? Let me know. There are also plenty of downsides to consider. I'm aware of that. But welcome to the world of investing, and I hope you enjoyed it. Follow us, happy investors. Then we're going to help you with more insightful information. And I would say, until next time,